Welcome to The Apartment Guys, where we discuss all things apartment investing related, including how to find cash-flowing apartments and raise capital. Join us every week for a high-level discussion and interviews that will take your investing to the next level. Now, here are your hosts, The Apartment Guys, John Prince and Tate Siemer.
Welcome back to another episode of the Apartment Guys podcast. This is a big one for us, guys. We've got a dream guest on our podcast, quite frankly. Mr. Neal Bawa is somebody that we look up to a lot around here at the podcast and our companies. He is a nationally known speaker, author, syndicator, investor, and is known as the Mad Scientist of Multifamily for his data and analytics driven analysis of markets and deals. And it's just such a great approach to approach things from data. As you said, data is everything. So Neal, welcome. Thank you so much for being with us.
Well, thanks for having me on the show, Tate. I'm delighted to be here.
Yeah. So, obviously, we're going to publish this afternoon, this evening. So it's March 24th as we record this. Things change seemingly by the hour with this situation, with the coronavirus and the economy and what the federal government's doing, what the states, are we going to go into a lockdown?
Stock market goes up 1,500 points, goes down 1,500 points, goes up 1,500 points.
Yeah. Yeah. So if, I just kind of want to give you the floor because you've got such a thorough grasp on as much of this as we can. Of course, there's so much unknown, and a lot of that unknown is creating a lot of fear. And we just want to do our best for our listeners to get as much data and as much factual, actionable information as we can out there to them. So, Neal, let's just kind of start with the human impact of what's happening right now. And in the last couple days, 2-3 days, how have things evolved and changed since maybe your last webinar?
So I did, my first webinar on coronavirus. I had 1,300 people signed up for that. I've never had that many. And then I have 1,300 signed up tonight because there's an incredible amount of interest in the impact of coronavirus, not just on our health, but on our business, on our life, as far as being sequestered, is concerned, and then of course on real estate and on stocks. And you're right, I have never seen anything change like this. Things change from hour to hour, things change from day to day, and so every day is different. And so if you want to know what's changed from the webinar, I am now convinced that a human tragedy of almost unbelievable epic proportions is going to unfold in the city of New York. I do not believe that at this point, New York has any reasonable chances of not being in that horrible position that Italy has been in the last 10 days, where they're making decisions on which people to give ventilators to based on their age and based on pre-existing conditions. Oh, you're over 60, you don't get a ventilator. You had cancer, you don't get a ventilator. That at this point is almost a given. And anyone that understands data science and understands what is known as the exponential function would agree with me. So at this point, they've missed the bus. They really had a chance to do an aggressive India-style lockdown or Italy-style lockdown, and they missed their boat last week. And at this point, when we look at this virus, we talk about case, cluster, boom. Well, unfortunately, for New York, it's case, cluster, boom, right? So they've gone from having 100 cases a day to having 5,000 to 10,000 cases a day. And keep in mind, because of the exponential functions, it means that these numbers are going to get very, very large, very, very quick. So just to give you an idea of how different states have looked at this differently, New York's cases are growing at 50 to 60% a day, which means that effectively their case count doubles every 2 days. And if it doubles once more, they're out of ventilators. And there's no reason why it wouldn't double twice or thrice more. So we're going to see an unbelievable human tragedy over the next week and a half or 2 weeks as their new cases, which they haven't even counted those cases yet, because a lot of those people are not symptomatic yet. But when they become symptomatic a week from now, and when their lungs start giving way two and a half weeks from now, we're going to see some horrible things. So that's what's changed. And if anything, this is a lesson for other people that are watching, other governors that are watching. And I'm very pleased to say that 2 days before I did my first webinar, I did a podcast for another podcaster, and I said, I'm not sure we survived this. Now I'm sure we do, because I see more states in the union going into lockdown, which is the only way to stop this thing. It is too powerful for us, and lockdowns are the only way to get around it. And we've seen that. I mean, Wuhan is open for business today after a devastating lockdown, but at this point, Apple stores are open in China. So things change. You have to look at the light at the end of the tunnel, and you have to react. And I'm happy to say that 1 hour before this podcast at 1 p.m. today, more than 50%, 50.1% of the US population is now under some form of shelter in place. Some call it safer at home, different terms for the same thing. 50% of our population. I think that's the tipping point. I think that we will see the other governors come in fairly shortly, I'd say over the next 4 to 5 days. I think that on the 30th, which is 6 days away, the vast majority of the United States, if not all of the United States, will be in shelter in place, which is what is needed to kill this thing. I keep saying this, Tate. If this is the Earth of the Avengers, this thing, it's Thanos. Thanos killed half the population of the planet. And in terms of the economic devastation of this thing, which is even more devastating than the healthcare impact, this thing is capable of killing 10% of the world's population. We have to take it seriously. And we have to understand that no one else out there is left that doesn't take it seriously. Did you see what happened with India earlier today? Yes. So a country of 1.3 billion people locked down every single part of the country. No, none of this bullshit about this city, that district, this state. 1.3 billion people. You can go out for 3 hours every 2 days. And if you go out outside of that time, either you have to prove you have a medical emergency or they will arrest you. That's what's needed. You have to be, all of those comments about our individual liberties, we have to suspend it if we want to survive. And I'm seeing encouraging signs throughout the world that people now fully, as of today, March 24th, fully understand what is needed to kill this thing. And I'm very enthused by that. What I'm phenomenally enthused by is what Congress is doing, because I think that, having a dysfunctional Congress, this time we have to give them, kudos.
Yeah, I know. Even from my perspective, Tate, I've seen, if you look at like a 2-week arc, even 2 weeks ago, there was a lot of misinformation and disbelief about the need for quarantining ourselves in our homes and kind of just letting this thing die out. And now, even around today, this week, it feels like a lot of those dissenting voices have died off, and you're seeing a lot more people really buying into the fact that, we need to just kind of go into shutdown until this thing can choke itself out.
Where do you think that the federal, obviously states are shutting things down state by state, ordering shelters in place. Ohio, I believe, just did it yesterday, if I'm not mistaken.
We're 17 states now, which is about half the population of the US, because there's also a bunch of cities like Atlanta and St. Louis and Philadelphia that have announced those shelters in place, even though their states haven't.
Yeah. So what do you have any thoughts on what the federal government might do over the next few days?
I'm terrified that they might start reversing some of the things that they're doing, because I think that Trump has a tendency not to listen to his to his doctors. And right. So I hope that he is listening to Dr. Fauci and Deborah Works and all of these other people that are telling him that he's winning, but they can't prove it to him yet, right? So they need to show him more proof. The problem with this system is, and I want you to really understand why so many people have trouble wrapping their head around this. So human beings are designed to think linearly. To us, we think 1, 2, 3, 4, 5. This virus thinks 1, 10, 100, 1,000, 10,000. So in the time that it's taken our mind to go from 1 to 5, the virus has gone from 1 to 10,000. Yeah. You understand how huge a difference that is, right?
Yes.
That's why people are having trouble believing that. But on the flip side of it, because the virus moves so quickly, and it does its damage so quickly. When we start controlling it, there's actually a gap between the virus's damage and our perception. There's a gap between the virus slowing down and our perception. At this point, it has begun to slow, but it's going to take us 10 or 12 days to figure that out. Why? Because the cases that we are seeing today, the cases that are coming to light, are infections from 7 or 10 days ago, because people are not symptomatic for up to 14 days. And even once they're symptomatic, it takes us a few days to get them into the system and start counting them. So imagine that what we are seeing today, the 50,000 cases worldwide that we crossed in half a day today, 50,000, by the way, isn't that a stunning number? 50,000 new cases since this morning.
In one day.
In one day. And the United States, is, in my mind, is split. The United States, since this morning, has had about 9,000 cases, which, by the way, is now the highest in the world. So nobody comes close to us. Everybody that was saying Europe is the epicenter has to change their mind and now say the United States is the epicenter. We've had 9,200 cases since this morning. And we have to divide the United States into two pieces: New York, New Jersey, and everybody else. Because when we look at our numbers, roughly 57, 58% of all cases are just New York, New Jersey. And then the remaining 43 are everywhere else. And what's even, and you might say, well, it's only 57%, you know, that it's not such a big deal. Yes, but the velocity at which their cases are growing is 2x, 3x the velocity of everybody else, which means that by next week, they'll be at 80 or 90% of all of our cases. So in my mind, the US is two pieces. We're doing okay, kind of okay, in the other 48 states. We're doing fantastically poorly in New York and New Jersey.
Sorry, Neal, what needs to happen in those two areas, in your view?
New York's density is too high for normal shelter-in-place methodology. They need to do a lockdown, and that is a curfew, and let people out 1 hour a day. Yeah. If they don't implement the National Guard, this will become by far the most devastating healthcare crisis they have ever dealt with. And I hate to say it this way, but it's going to make 9/11 seem like nothing. Mm-hmm. So I don't think they fully understand it. I do think their governor is beginning to understand it. I don't know if you saw his latest press conference. He was spewing poison, just blasting at people, because he now begins to understand what he signed up for, right? And how horribly bad his situation actually is. But it's not horribly bad for the rest of the US. We have the time to recover, and that's where the good news comes in. A week and a half ago, when I was writing this webinar, I said there's two scenarios for this. One scenario is the gloom and doom scenario. 50 to 150 million Americans get infected. We lose 8 million lives. Our economy completely tanks. Real estate is completely illiquid. That's what I saw happening. It was the default scenario 8 or 9 days ago. Things have changed a lot. We've gone from 8 million people being sequestered 10 days ago to half of the United States, right? So we've gone to 148 million people being sequestered in that 8-day time frame. And our chances of moving this to scenario 2 are vastly better, leaving New York aside, than they were 8 days ago, because half of America has done the right thing already. And the other half it's not like they're not doing it, right? Your restaurants are shut down, aren't they? So yeah. A lot of people are sitting at home, and so that's going to slow the virus down. So we're doing the right things. And scenario 2 is we see, 250,000 cases in the United States, maybe 500,000 cases. We see 5,000 to 10,000 deaths, which still keeps it under the flu in terms of pure death count. And obviously massive economic devastation, but Congress is doing the right things. It's a $2 trillion package, and its keystone is that people that are laid off get their salaries for up to 4 months. That is a fabulous number. That's a fabulous number, because people started getting laid off in the second half of March, which means that if needed, we can go until the second half of July and pay people, right, their salaries. On top of that, if you're a family of 4, 2 kids, 2 adults, you get $3,000 of helicopter money that is shipped to you within the next 30 days. And you can use that money to buy groceries or pay rent or do whatever you need to do. And then Fannie and Freddie at this point have said mortgage abatement for all apartment owners as long as you don't evict people. So wow. A lot has happened, and a lot of it is very powerful stuff. Today, any apartment complex that is affected by this can apply for mortgage abatement. So the chances that we will run up millions and millions of evictions are now much lower than they were a week ago, because we're not paying our mortgage. And I can tell you within 10 days, tax authorities, local tax authorities will also declare a tax holiday for apartment owners.
Wow. So, and then of course, on the single family residence side, there's going to be, relief there as well. But
there's abatement. Yeah, that's right. You don't have to pay your mortgage, right? So they're pushing the mortgage out. They're putting tax filings out. Businesses don't have to pay taxes. So usually I'm very skeptical of what Congress and the Fed does, but I have to say, they haven't just thrown the kitchen sink at it. They've ripped out every single sink from every single room in the house and thrown this thing at coronavirus at the same time, which is what needed to be done, because this isn't a standard villain.
Yeah.
This is a villain that multiplies. It doubles its size every 3 days. So you're fighting a monster. I mean, imagine a movie where you're fighting Godzilla and he's 800 feet high, and then 2 days later you're fighting Godzilla and he's 1,600 feet high.
Mm-hmm.
Right? So and I think Congress really understands that, because at $2 trillion, this bill is already 3x what it was in 2008, and it needed to be that. By the way, $2 trillion is not enough, but I think what they've done is they will stem the bleeding if we can just get control over the cases. If we get control over the cases, this isn't a global devastation. It's not a depression. It's going to be a very, very steep, very, very sharp recession in the second quarter and the third quarter of this year, and then we bounce back, because fundamentally there really was nothing wrong with the economy, and the amount of money that we're infusing into it, both direct money from Congress as well as all the stuff that the federal banks of the world are doing, interest rates at zero, is a huge amount of stimulus. It just takes 6 months for that to push things up. So the bottom line is, if you were thinking about being in the apartment industry, Q3 and Q4 of this year will be your opportunity. You will see lower prices. It will be a buyer's market. By that time, even though they're not stable today, by that time, capital markets will stabilize, so people will be willing to give you loans. You'll probably need to leverage it to a lower level, and you'll probably need to impound 6 to 12 months of mortgage payments to buy. But the prices that you get temporarily in Q3 and Q4 will make all the sense in the world. We've all been saying for years, this doesn't make sense. The math doesn't make sense. The numbers are too high. Well, we're going to get a temporary decline there. So my message, the key message is this: if you sat on the sidelines in 2008, if you kept saying in the last 3 years, it's too expensive, now this is your chance in Q3, Q4 of this year to act, because you are going to see discounts.
Neal, I think a lot of us have seen similar projections, right? That we're going to see a pretty sharp recession over the next couple months, and that things should bounce back towards the end of the year. What lingering effects do you see from this coronavirus situation after people go back to normal life, after people come out of their quarantines and, business goes back to usual?
So the answer is business will not go back to usual, because it won't. When you look at what happened to the airline industry after 2001, if you study the Delta, it took them more than a year to recover the seat count that they had before 2001. So when I say that by Q4 things will go back to being normal, what I mean is capital markets will be normal, tenants will be paying rents, but to expect that the apartment industry on December 1st is going to look exactly like it did on Feb 1st is not reasonable. This is a catastrophic event. It has affected 193 countries in the world. It has caused untold devastation. All we can expect is that by the end of this year, things will be fairly normal, and banks throughout the world will be working together to normalize. Are there going to be bubbles bursting? Sure. I think that corporate debt is a bubble that could burst, and if that happens, then it just becomes a bloodbath, and so there's a chance of that. And commercial mortgages are also somewhat of a bubble, and that bubble could burst. It's much smaller, so it doesn't have the sort of impact that corporate debt does. So there's risks. There's a huge amount of risk. But here's what I don't want people to expect. I don't want people to think that in December you're going to feel the same way about anything as you felt in, let's say, Feb or Jan. That's going to take more time. This thing is huge.
Well, I guess that's what I mean by lingering effects. Obviously things won't be exactly the same. I mean, obviously, and you don't have a crystal ball, but I mean, would you expect to see, vacancies? I know you had mentioned on another podcast that we've kind of, seen 95% nationwide occupancy. Do you expect that to drop to maybe like 90%?
Yeah, I'd say so. I think you're going to see drops in occupancy. I don't see how we could maintain our occupancy at 95%, even with that stimulus, assuming we beat this virus and by June we're in that position. Keep in mind, this virus is not gone. It'll flare again. And when it flares again, we'll have shutdowns again. Those would be local, not nationwide, but wherever the flare up is, we would have shutdowns again. So it's going to be one of those 2 steps forward, 1 step back situation. But I do expect vacancy to fall to 90%. So people are like, so why are you looking to buy in Q3? My answer is simply this. I expect that vacancy to build back up to 95% by Q1 next year. So I'm just underwriting a really horrible first 2 quarters of my purchase, but I'm getting a discount possibly of 10 or 20 bips, and I'm getting interest rates that are the lowest in history. So the math still makes sense. If it didn't make sense, then I would just sit on the sidelines.
Mm-hmm. Well, Neal, it's the human crisis is almost unspeakable, and you do a great job of putting into perspective and putting into context. This is the Apartment Guys podcast, and so we've kind of already started to talk a little bit about it from an apartment investing standpoint. I guess my question for you is, and I think I already know the answer to this, but do you underwrite anything right? I mean, is it possible to underwrite anything right now? Is it possible to have any assumptions that are solid or anything like that?
I'm going to give you a very straightforward answer. This is the question I get asked the most.
Right.
I believe that today we are standing at the event horizon of a black hole. And if you understand what that means, you know that not even light can escape that black hole, correct?
Right.
There's no way to underwrite today. There's no methodology that anyone in the world has to underwrite today. In my mind, no one should be underwriting anything for the next 60 days. And you might say, oh, 60 days is a long time not to underwrite anything. No, because in Q3 and Q4, you'll have more opportunities. It's possible that there will be more sellers in the market in Q3 and Q4 than there will be buyers. You'll have plenty of opportunity to make this up. And also right now, look at the mindset of your investors. Mm-hmm. They're not sure why they're not investing, but they're not investing because they're terrified. Mm-hmm. So to me, the next 45 days to 60 days is an alt stop. I don't think that anyone should be buying properties during that time, because what is the basis of your underwriting? No one knows. No one has any clue. Right. No one knows where we end up. So my advice is, if you're not hard on money, walk away. And if you are hard on money, walk away.
Yeah.
What do you think, Neal, about taking advantage of this opportunity, not buying properties, but maybe with some very conservative underwriting, putting some properties under contract, but with much longer due diligence, maybe like 120 days of due diligence, so you can ride out the storm and still maybe take advantage of lower prices, but you're not putting yourself at risk. What do you think about that strategy?
I wouldn't do it unless the seller allows you to wait for 120 days to go hard on the money.
Yeah.
So it's really about the earnest money at this point in time, not about the due diligence, because you obviously don't need 120 days to do due diligence on the property. They know exactly why you're doing it. You want to drag it out to see what happens. So today it's important for you to maintain the ability to retrade. 55% of all deals in the market today are retrading. 55%. Mm-hmm. That's up from less than 5% a month ago.
And I actually don't know what that means. What do you mean by retrade?
Just renegotiating.
Renegotiating on price, renegotiating on,
I see.
On everything really. So 55% of the deals are in retrade, and some of them are in retrade simply because the lender no longer wants to fund it at that price.
Right.
So if people ask me, is the price of multifamily properties going to be affected? And the answer is, it's already affected. The question you should be asking me is it affected for the short term or it's affected for the long term?
Right.
Well, I can tell you, because the stimulus from the Fed and the stimulus from Congress is A+, the question The answer to that question depends on our medical ability to fight this thing. Right now, if the rest of the US states go into a 3-week to 6-week quarantine, we will win. We will fight this thing, and it'll flare up again, and we'll have problems with it. It's like, for example, it's flaring up again in Hong Kong, right? So they killed it once, and then now it's come back, and now they're kind of backing down. They're going back and adding some of the restrictions that they've taken off. So it's a delicate place, but I think that at this point we win if we don't do something stupid like opening the country up again on the 1st of April. We need to give it more time. We need to actually see the wave crest and go downwards before we stop. We need to learn from what the Chinese did. So as long as we learn, I think we do well there. And as long as we do well there, my answer is the prices of multifamily go down for 6 months.
Mm-hmm. Well, Neal, what are you telling your capital at this point? I'm sure they're all checking in with you, but your existing investors and maybe investors that you have in the works or have relationships with. What's your main message for them right now?
The first message is I am spending a great deal of time, a great deal of effort messaging my existing investors. You have to basically do this in levels, right? Existing investors, very strong messaging, and making them understand that we've got options. My properties have more than 6 months of operating buffers so that if no one pays me rent tomorrow, I'm fine, right? Plus, I have mortgage abatement, which has already been offered by the feds. So first, your investors need to understand that the world is not ending for multifamily. Out there, if I was running a restaurant or an airline or a hotel or an Airbnb, boy, the world is ending. I mean, it seems like that because their revenue is down 90%, right? If I was a cruise line, you're down 100%. But for apartments, there's lots and lots of reasons why we are not going to see an 80% decline in revenue. Remember that when that $3,000, that helicopter money, $3,000 per family is thrown at people, what we've seen in history in bad times is people first pay for food and then they pay for rent. And I understand that people know that they cannot be evicted at this point of time, but we still have a huge number of threatening messages that we can give them. We can say, well, nothing is going to prevent us from reporting you to credit bureaus. And by the way, we can't evict you, but we can still line up the eviction. Mm-hmm. Nobody's stopping us, correct? So we can still process the eviction, and the judge will not give us the ability to remove you, but we can queue it up. So we've got options there. And as we have these conversations, and I don't want to be threatening to any tenants right now, obviously their situation is really bad, but I want to let them know that we've got options too. And once they know that, and once they have money in their pocket, a lot of them will pay rent. So I expect maybe 20, 30% delinquency, which I think we can absorb because we've all got operating budgets. And if it's hitting us a lot, we're going to not pay our mortgage, which the banks are okay with. So we've got options. So number one, I am messaging my investors about, look, we've got lots and lots of options here. Second, I'm telling them these super low interest rates cannot be rolled back for a minimum of 1 year, possibly 2 years. So this is good news for us. You're just not going to feel this way for the next 6 months. And third, I'm letting them know about all of the things that I'm doing to keep my community safe. So this is the time to be messaging your investors. I'm doing it both by writing long emails and videos. So I've recorded videos for each of my properties, and I've recorded a general video that's about 12 minutes long. 12 minutes is a lot of time. That's like reading 20 pages, right? So I'm giving them an incredible amount of information about where they stand, and that is going to prevent the panic. Then the next group that I'm talking to are people that show up for my Raise webinars, but they haven't yet invested with me. They're not invested with me in any of the properties that we're currently in, but they show up at events and they fill out forms saying I'm accredited. And I'm reaching out to them and giving them that similar messaging. Obviously, I can tell them a little bit less because they're not in my projects, but I'm doing the same sort of messaging. And then I'm doing messaging for the 26,000 people that are in my database. And that messaging you've already seen. I'm doing webinars. I'm doing podcasts. I'm telling people where I think we stand. And most importantly, the message that I'm sending is, hey, I'm on top of it. Mm-hmm. It's a bad time, but I'm on top of it. And that's what every syndicator out there should be doing, messaging their database. I see a lot of people doing it. I think they're making a mistake. They are only sending emails with text. And because I have now received 600 emails about the coronavirus from everybody, including my maintenance mechanic to my bank, I'm not reading anymore.
Mm-hmm.
They need to provide video.
Mm-hmm. What a great idea, a video message to your investors, and could really use that strategy for a lot of different relationships at this point.
Yeah, people are sick of reading, because I get 20 emails a day about, Amazon's response to coronavirus, and Best Buy's response and Airbnb's response. I mean, how many emails can I possibly read?
Right.
I was going to say, I saw Neal had a really great idea that I really liked on another podcast that I heard you on. For people in this time, if you have multifamily, it's not a bad idea to offer a month of free rent to your renters. I mean, if they're not going to be paying rent anyways, and what you had mentioned is, let's say their rent is, $1,000 and they've got 5 months left, you can take that $1,000 of free rent and then offer to, amortize that over the remaining 4 months that they have left.
That's right. And we might even do 2 months like that. We might say, we'll give you 2 months, because in a month it may not be over. They may not have that money. So what we're doing is we're rewriting their lease, where we're taking the existing 2 months of rent and we're moving it over. And to make that work, we're even adding in a new component. And that new component is, okay, so what's your rent? 1,000. How much can you really pay? Oh, I can pay 350. Okay, great. You pay 350. Now, what about the remaining 650? Here's what we're going to do. We're going to take half of that from your deposit. That's about 325. And we're going to take the remaining 325, and we're going to repeat that next month as well, by the way. So next month also, you need to pay me 350. Okay, don't pay me 1,000. You pay me 350 this month, 350 next month. I'll take 325 out of your deposit for next month and next month. And then the remaining 650, I'll amortize it over the next 6 months. So now you're paying $100 more over that time. Because now they have certainty for 2 months, people are more willing to accept what you're talking about.
Yeah, I thought that was a brilliant idea. Renters are really getting it, the worst right now. And
you have to be sympathetic.
You've got to be sympathetic, not just from a business standpoint, but just from a human standpoint. We kind of do need to pull together and to offer options like that to your renters that make sense for you, but also help them to have security, is something that is not only good business sense, it's just something that you should do as a human to help your fellow man out.
Yeah.
So,
hey, let's geek out for a second. Neal, you're so great about market analysis and market data. And we all know the markets that you like, and especially here in Utah, where we're based here in Salt Lake City. We know that you like Provo, Utah quite a bit, and St. George, Utah quite a bit. Has anything changed at all in terms of your thinking about specific markets that you've been hot on?
Very much so. I mean, as you guys know, I look at markets based on, if I'm looking at, city level or metro level data, I'm looking at 5 metrics, and you can find a very nice course. It's a free course on multifamilyu.com. Go there, click learn, and click location magic, and you'll find that there's 5 city level and 5 neighborhood level metrics, and I can name them for you, and then I'll answer your question. And they are population growth, job growth, home price growth, income growth, and crime reduction. I look at those 5 numbers and I pick my cities. Having said that, your question was, has anything changed? And the answer is yes. I cannot ignore bargains in the marketplace. And so in Q2 and Q3, my purchases will be more opportunistic. I'm looking at, okay, I'm not looking at what the job growth and what the income growth is. Because if I look at job growth and income growth and I get a 2% discount off of market, and I look at areas in the market that are distressed and I get a 25% discount, then it makes sense to ignore that job growth at that point, because I have millions of dollars of equity built in on the day that I'm going into the project. So it's likely that my purchases in Q3 will be opportunistic, and I'll break a number of my own rules because I'm receiving a massive amount of built-in equity on the day of purchase.
Interesting, yeah. And we know that you'll share the rules that you break with us, because you're such a generous guy sharing what you're up to and your different strategies and thought processes.
I'm transparent, and it works really well. In times like this, people will flock to folks that are transparent. So I think sharing what you're doing with other people makes all the sense in the world, and I think I'm reaping the benefits of that. I'm doing raises. As you can imagine, my next raise is a public storage raise, and that's the big reason for that is, storage hasn't been hit. I mean, and we've seen that, right? So you look at the real estate trusts that are down. No surprise, senior housing is hit the most, and public storage is hit the least.
Yeah, and multifamily housing is kind of in that bottom third.
It is in that bottom third where it deserves to be, especially now. So the market hasn't figured out what I know as a real estate professional. That is that when we throw helicopter money of $3,000 per family at people, the second thing that they're going to pay for after food is rent. The market needs to see that happen. And then you will find multifamily pretty much at the bottom of that list next to self-storage.
Mm-hmm.
Not in the lower third.
Mm-hmm. Great. Well, that's good for us that are in apartments to know, and you talk about the magic of multifamily. I know you have a Facebook group named that. We talk about it a lot here, and all the reasons that we like it. And I mean, we've talked about it in the past being recession resistant, or you don't want to ever say recession proof. So, but this is kind of this is a stress test, right? To all those statements that we've always made about the multifamily asset, and this will really show, in the grand scheme of things, with all the other options out there for where to put capital, this will really show where the rubber meets the road. And my prediction, I'm sure yours is probably similar, is that multifamily in the long run will end up shining.
I think it will do well, I believe, and this is not a conversation for this year, but by next year, we're going to see a rebalancing of asset classes, and that rebalancing is going to be in favor of real estate. Because what investors are seeing today is that real-time assets, and real-time assets are hotels, Airbnb, airlines, retail. These are assets that sell by the day and by the hour. If a restaurant doesn't sell its menu today, they can never come back and get that money. Yeah. Okay, it's gone forever. And the public and Wall Street will have a new understanding that assets which sell by the quarter, like real estate, and you might say, well, no, we sell by the month. No, we really don't, because not much changes for us on a monthly basis, right? So, and keep in mind that we have leases of a year. When a person walks into a restaurant, or he walks into a restaurant, he's thinking about the next hour, and he's only paying for that next hour. When a person walks into a hotel, he's thinking about that night and paying for that night. When a person walks into an apartment complex, he thinks about paying for a year. And our industry has never gotten that benefit because there was never a use case that showed that stuff that is sold by the hour or by the seat should not receive the same cap rate multiples as stuff that is sold by the year. And this virus has proven it to people. If you're a stock market guy and you didn't jump into real estate, today you need to see the difference, right? Stock markets, depending on the day, are down 35, 40%. You look at us, our occupancy hasn't dropped. And you might say, no, it's early in the game, and you're obviously right. But I want you to see what happens over the next 6 months and see where we end up with. Certainly, we got the better part of this in 2008. You saw that there was only 1 year of negative rent growth, which is 2009. 2010, rent growth was positive. You can't say that's same for stocks. It took a long time for them to come back. So bottom line is, people that are looking at the stock market, if they are data-driven, they're going to realize that there's a significant difference in quality between real estate and stocks as an asset class. Most importantly, I think those billion-dollar and trillion-dollar funds out there are going to realize that. So I think there's going to be a repricing of risk.
Neal, quick question. It's a little bit tangential, but with all these people pulling their money out of the stock market, do you see an increase in demand for opportunity zone deals coming up?
Not in the short term, no, because I think that a lot of opportunity zone money was profit money. And we've just seen a decline. I mean, if the stock market goes down by 40%, you could see more than a 40% decline in opportunity zone projects. So in the short run, I don't. In the long run, I don't think anything changes. Opportunity zones are a very powerful methodology. There's a huge tax saving there. I just don't see it increasing the demand for opportunity zones in the short run.
Yeah. Neal, we're so grateful. We're going to wrap this up. I just want to say that you are so generous in your sharing, and you're taking care of your residents, you're taking care of your investors, and you're taking care of the people that learn from you, your students, the people that you coach. And that's really the best you can do in a time like this, I think, is just take care of your people and make as much of an impact as you can. And you're certainly doing that. So we've got
and so are you. I mean, I see the work that you're putting into this podcast. I see that your listener count is going up, Tate. I think you're following, and doing the same sort of things. And that's what we are here for, to share. And I think the sharing has to be constant. I'm inviting a lot of my friends to share at multifamilyu.com. So if you go there, you'll see our last 50 webinars. They're all data-driven. So we only invite data-driven speakers. And I think that methodology has to continue. People have to keep learning.
Yeah. Well, with that, I got to say I'm in a little better mood. I don't know if that's the right word. I'm a little more hopeful after this podcast, I guess, is the best way to put it.
You should be. Yeah. The right things are happening.
Yeah, that's great.
Not just in the US, but worldwide. I was worried about India. India is my country of origin. And I was like, well, they don't have the healthcare system. If it gets out into the community there, they could end up with, 20 million dead. But I think what they're doing is exactly the right thing as well. So let's keep our fingers crossed that we understand that this quarantine is necessary.
Yeah. All right. Well, Neal, thank you so much.
Yes, thank you, Neal. We really appreciate it.
Yeah. And we will be back, and we're doing as many podcasts as we can these days because we want to keep people as closely informed from, our perspective is hopefully we're offering some value, and we're aggressively looking for, bringing guests like Neal on, and I'm going to keep you guys as closely posted to what we think's happening, especially from a multifamily perspective. So thanks for listening, folks, and we'll see you on the next one.
Thank you, guys.
Thank you, Neal.
Thanks, Neal.
You've been listening to The Apartment Guys. Be sure to subscribe on iTunes or Google Play to get new weekly episodes and to drop us a review. For more, please follow us on Instagram and Facebook, or visit our website at apartmentguyspodcast.com. Until next time, take massive action steps and rock on.